Hello, everyone. I'm Kyle Sharapita. So, what does a top Fidelity portfolio manager look for in dividend-paying companies? In 2024, today's guest was rated by Morningstar as one of the top 10 female portfolio managers based on risk-adjusted returns. For Canadian investors, she manages both global and U.S. funds. And today, in addition to sharing what she looks for in companies, we'll hear an outlook for the remainder of the year. I'm pleased to welcome today's guest, portfolio manager Ramona Persaud. Ramona, thanks so much for joining me.
Thanks for having me.
So let's start with the basics. What is a dividend?
So a dividend is a form of cash flow that comes back to an owner of a company, in the case of a dividend-paying stock. So companies ideally run their business, generate a lot of cash off of that business, and then they have a decision about what to do with the cash. Typically, they need to reinvest some of the cash to keep the growth of the business going. And ideally, they would have some of the cash left over. So of that leftover cash, they would give it back to the investors or the owners of the company. So you're getting a return on your ownership of the company in the form of a cash dividend.
Okay. Yeah. And for Canadian investors, you manage Fidelity U.S. Dividend Fund and the equities sub-portfolio of Global Dividend and Global Monthly Income, among others. I want to make sure I had that right. So what do you look for in a dividend-paying company?
So I'm looking for typically a combination of quality. So a company that is what we consider high quality, and I'll get into that a little bit later, but also a company whose valuation, so what I'm paying for their stock, is attractive. Because when you combine attractive valuation with almost any other metric, including quality, you tend to improve your odds of good excess return. So back to quality companies are those that tend to have some sort of competitive advantage versus everybody else who does what they do. So they generate pretty good returns on their capital that they invest, and they're able to sustain those advantages and therefore sustain the returns and therefore generate lots of cash flow off of the business. And so if we can identify companies with sustainable quality characteristics, that's the first thing we look for. And then if we can buy the stocks of those companies at attractive prices, typically when there is some measure of fear in the markets in general, where those stocks sell off, and you combine those two features, quality and what we call valuation, then you can make pretty good excess return over time in the stock.
Okay.
Yeah.
You mentioned fear there.
Yeah.
There has been, I think, a lot of fear,
Lots of fear.
in the markets this year.
Yeah.
What's the biggest surprise for you so far this year? Or does nothing surprise you anymore with all the time you've spent doing this?
So 2024, in retrospect now, I think was a very good, if you will, layup for 2025, in the sense that 24 to me was characterized by lots of spikes in volatility for all kinds of different reasons. It sort of started in the spring with the French election. If you're a global investor, there was volatility all over the world. So There was French election in the spring, and then there was in the early summer, there was a shift in market mindset to more of a risk appetite from inflation subsiding. Then there was a violent unwind of the yen carry trade later in the summer. Then there was election volatility. So there were just all these little bouts of volatility all over the place. And I think that actually, it gave us sort of reps or practice with just absorbing a lot of like constant volatility, which, as we then saw in 2025, continued, but at a much greater magnitude. So if there's perhaps, to your question, surprise in 2025, it's sort of the difference in amplitude or magnitude of the volatility in 25 versus 24. But to me, 24 was really good practice for what we're seeing in 25.
Okay. And I'm also curious, the volatility that we saw 24 going to 25, do you draw any parallels to prior bouts of volatility, or is it all a little bit different? And I will say, I remember about 5 years ago when COVID first hit, everything you were sharing at the time about tracking flight data and seeing how that was impacting what was going to hit in the States and kind of seeing things before they happened. I'm just curious, you've seen a lot of up and down, a lot of bouts of volatility. Any parallels?
So in some ways, volatility is volatility, right?
Okay.
And for the way that I invest, volatility is an invitation to get involved in the market. So instead of something to run from,
Yeah.
It is an invitation.
Okay.
In terms of the way that I invest, because that's when the valuations that I was talking about before, that's when valuations get really interesting, and there's enough fear. Volatility is a measure of fear in a way,
Right.
and there's enough fear in how securities are priced that you can buy those great high quality companies for prices that you would not usually get. So in that sense, all volatility is the same. What's different? COVID, of course, was so different from, say, the volatility that we're seeing so far this year, any volatility we saw last year. What's different is what drives it from moment to moment.
Right.
And the what is driving it is what differentiates what gets cheap versus what doesn't get cheap. So in the case of COVID, or even this sort of tariff-related volatility of the last few months, sort of everything sells off indiscriminately. And that's what I look for. So there's sort of volatility that might be specific to one area where you don't get as much opportunity or as much of an invitation.
Yeah.
And then there's volatility that's all across the market. So COVID was one, tariffs to some extent is one, the global financial crisis was one. When you get really big moments, the entire world sells off. And then it is a massive invitation to get involved in investing.
Right. Would you say then that did your approach shift at all this year based on this volatility being a bit different, or was it just status quo?
Did my approach shift? So this is when we get into sort of like some nuance in volatility.
Right.
There's volatility that's a little bit more fundamentally driven. So COVID was not so fundamental. Tariffs maybe not so fundamental. But there, maybe something that's economically driven, like interest rates or more fundamental recession flags.
Right.
So I have termed the volatility we've seen this year, I've termed it exogenous or more exogenous than usual. And all that means is that it's a lot less predictable. And that's because it's being driven by sort of politics in a way, and political, let's call it negotiation maybe, that is fairly unpredictable. It's it seems like a lot of game theory. You can argue whether the execution is what you would read about game theory in textbooks, but the point is that it's pretty exogenous, it's pretty unpredictable, and when volatility gets to be that exogenous, to me, there's a continuum of flexibility to conviction in how you invest. And you have to lean way more flexible than conviction-oriented because you cannot predict what will happen.
Right.
So as we saw with tariffs, we went from really aggressive tariff language. People in Canada know better than almost anyone else what that felt like. And then that expanded to the whole world. Really aggressive tariff language that was difficult in the markets to recently much less aggressive tariff language where you get this snapback in markets. And could anyone really predict that? No. So in my mind, my approach has been to be extremely flexible in order to, of course, protect downside in my portfolios, but also still capture some of the upside on the turn when it's this unpredictable.
Okay. That's great.
So that's a little different from usual.
Yeah, no, it sounds like it. I'm curious too now, going forward, what do you think for the rest of the year? Are we going to see some more continued volatility, some more swings? Is it too hard to say? I'm curious to know, since you focus on both U.S. and global, your thoughts on that.
My guess is that it probably continues, and it probably continues in this what I've called mercurial way, which is sort of definitionally unpredictable.
Right.
There's a way of testing the markets, testing the treasury markets and testing the stock markets that seems to be going on, but who knows?
Right.
So really what I'm trying to do in my funds is diversify enough. So that's that flexibility that I talked about. I think when you get markets like this, you just diversify a lot so that there's lots of ways to win with diversity. So I am also trying to find companies that have more control of their destiny than average in a market like this. So that would be like companies that are in the midst of an internal turnaround, an internal restructuring, a special situation company, a company that's just maybe extremely cheap so it can absorb a lot of bad news or a lot of volatility.
Right.
Companies that are not so tied to AI or GLP-1s. The great thing about investing globally is there is so much choice.
Yeah.
So you can go to all sorts of pockets of the world and just find a lot of relatively uncorrelated risk.
Right. Is there a particular region in the world that you're seeing more of those opportunities right now?
There isn't a particular region because tariffs have
impacted everything.
have gone
including
global.
An island of penguins.
It's sort of a globally based fear. So that's actually a better setup than if there are particular regions, in the sense that you can really stock pick because everything gets sold off indiscriminately. So you can go to all sorts of different places. So at one point, coming into this year, and I'll give you a recent example, the U.S. versus what I call ex-U.S., everything that's not U.S., and specifically Europe, had gotten to a really extended valuation difference. So I measure things in terms of standard deviations, and it had gotten to like over 2 standard deviations. And when you go past 1, that's a lot of the data points. And when you get to 2, that's most of the data points. So once you get beyond 2, it's pretty rare. And so that was a signal. And then we saw that show up in how stocks performed outside of the U.S. and particularly Europe versus in the U.S. And there's still some what I call valuation dispersion between those 2 regions. So European banks have been more interesting than U.S. banks or some parts of European consumer. I've been looking more at pair trades versus any given region versus another. So stock to stock, one stock being much cheaper than the other. A lot of times you can get European multinationals that are a lot cheaper than the U.S. equivalent. The U.S. has gotten a pretty big premium in the last decade plus. So not necessarily region specific, but stock to stock to stock all over the world.
Final question for you. I know you grew up in New York and you're in the Boston area. How are you finding Toronto? Been here for a day or so.
I love Toronto. Toronto's not new to me. We have a big community in Toronto as well. And so growing up in New York, the one vacation that we did every year was in August. We would get in the car from New York and drive to Toronto. Nice. All of my summers growing up in New York, we came to Toronto. So great. I love Toronto. I love coming back. It is, great. And what I really love that reminds me of New York is it is so multicultural.
Right.
And it really speaks to Canadian openness and acceptance to people from all over the world. And I really appreciate that.
I agree. Oh, that's great. Thank you so much for joining me today. I'm glad you were able to join me here in the studio while you were in town.
Yes, my pleasure.
That's great. Thank you.
Thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.